I'm Matt Miller. Today I'm pleased to be joined by Jody Jonsson, Vice Chair of Capital Group and President of Capital Research and Management Company. Jody has spent more than 3 decades at Capital as an investor and leader, with a perspective shaped by nearly every market environment, from periods of rapid innovation to moments of real stress in the capital markets. In today's episode, we'll step back to talk about the role of active management, how investing has evolved over time, and what today's environment means for long-term investors. Jody, thanks so much for joining us today.
It's great to be with you, Matt. Thank you.
It's great to be with you. So we're here today to talk about the role of Capital Group as the world's largest active manager and one of the world's most experienced investment managers. And just to put it in context, we today have $3.4 trillion in assets under management. That breaks down approximately 80-20 in terms of equity versus fixed income. And we manage about $2.1 trillion in global retirement assets, which serve millions of people across 401ks, IRAs, and pensions. In what ways has investing changed over the past decades?
Well, it's changed a lot in the course of my career, which is 35 years at this point. Probably the biggest change has been the rise of passive relative to active. But as you well know, as everyone knows, passive has become an increasingly large chunk of the U.S. market, roughly about 50%, I think, of the assets under management in the U.S., not quite as high outside the U.S. So that has changed market dynamics. There are a lot of owners via passive who aren't really making a judgment on valuation. They're just along for the ride, essentially. You also have a lot more very short-term participants, hedge funds, quantitative traders who are often trading on very, very short-term information. And so there are fewer folks like us, sort of traditional, long-only, very fundamentally research-driven active investors. So the market's reaction time is a lot shorter, and there are fewer investors who I think truly take a long-term horizon, which is what we try to do.
And I've heard you talk about this before, but that differentiates us in important ways. Can you talk a little bit about that?
We try to take a multi-year, if not multi-decade horizon when we're thinking about investments. First, it matches the horizon of the people on whose behalf we're investing. And it's also how we compensate our own investors over multi-year periods, not over the last quarter or even in the last year. So we're trying to look at rates of change in industries and companies and think out a decade or so and really get the long-term big picture right on these global changes in technology or healthcare or whatever the sector. We're really trying to view winners and losers in these changes over a much longer period of time than is typical for the market today.
And just to be, because I think it's something that many people don't realize, is I've heard we compensate portfolio managers largely on 5- and 8-year results, and that makes us in a market filled with hedge fund folks and others who are kind of quickly in and out. Say a word about how that helps us steer by a different star.
We're really trying to invest for the long term, for the horizons of the people that we're investing for, people who are investing for retirement or children's college education, for example. So we don't think it makes sense to be overly reactive. Of course, we do look at 1-year results, 3-year results, but the bulk of our compensation is paid on 5- and 8-year results, where we're really trying to produce consistent results over a long period of time rather than just, 12 months at a time.
Now, one thing we've heard in recent years, there's kind of a narrative that the number of publicly listed companies has gone down from around 7,500 back in 1997, and now about 4,000 listed companies in the U.S. Is that a concern that the opportunity to invest has shrunk? How do we think about that?
I think this has turned into a narrative that somehow public markets are not serving investors well because of this shrinking number of public companies. And while it is true that in the U.S., the number of public companies has shrunk, outside the U.S., the number has grown. And I think it's something like 50,000 public companies worldwide. But we have to look at the reasons why. Part of this is the natural evolution of industries in the U.S., where they've gone to winner take all or winner take most. There's been a lot of consolidation, merger and acquisition activity. But if you step back and look at the U.S. market over the last 30 years, it's gone from a market value of $7 trillion to $70 trillion.
Wow.
It has compounded at over 10% a year for 30 years. And that's despite 2 drawdowns of 50% each in the early 2000s and in the great financial crisis. So public markets have served investors well. And the notion that somehow because the number of companies is shrinking, it doesn't tell you what's happened to the total value of the market where the capitalization's expanded tenfold in 30 years.
That's huge.
It is huge. And it's served investors very well.
And it gets lost in this discussion just about the shrinking top line number of public U.S. companies, I guess. Now, the mutual fund celebrated its 100th anniversary last year, which kind of is astonishing. Mm-hmm. Do you think that structure is still going to be around in the next 100 years?
The mutual fund served investors very, very well because it was low cost, scalable, gave daily liquidity. It gave a lot of advantages to everyday investors. And the mutual fund has continued to evolve over time. The ETF is sort of a natural outgrowth of the mutual fund. It's a structure that's in some ways better suited to certain investors, tax-sensitive investors, for example. But the mutual fund itself is not going away. Mutual funds are a staple in retirement plans. Retirement plans are investing for decades. So there will be many investors who are owning mutual funds for, the next 50 or 60 or 70 years, probably. But I do expect that vehicles will continue to evolve and change to meet the needs of different investors. And in particular, active ETFs are a great innovation of the last several years. Before active ETFs and passive were basically synonymous. Mm-hmm. And that was the way most people accessed passive. But the active ETF advantage has allowed investors now to access all sorts of different investment strategies via ETF in a way that may be better for their particular needs. So it's expanded the market, and active ETFs are taking share from passive ETFs now. So we view that as a very positive development for investor choice.
Now, one aspect when things like active ETFs get introduced, there's a whole regulatory and policy process involved in that. And I know among the many hats you've worn at Capitol, you work regularly with our Washington, D.C. team on advocacy efforts. Why has that been important to you? What'd you learn from it? Well,
I think, it's easy to think about advocacy as sort of lobbying, right? Mm-hmm. We think about Washington and everybody trying to argue for what they want. But really what we try to do through advocacy is argue on behalf of the individual investor who we represent. And we're advocating for healthy capital markets, promoting retirement savings, and fair regulation, transparency, things that are good for investors. We don't go there to advocate on capital's behalf. We're doing it on behalf of the millions of savers and investors all over the country in every congressional district.
Right.
And what we find as we go to visit people on the Hill is often I think the people we're talking to in Congress, they don't necessarily realize how many people in their district are clients of ours or how many financial advisors might be in their districts. This is very much a sort of kitchen table issue. And I think we are seen as a very thoughtful, long-term oriented company that has been around for almost 100 years, has the interests of investors at heart, and is very credible and knowledgeable on these issues of policy that they're trying to shape.
So we're really functioning to help educate them in some ways.
Absolutely. There are a lot of complex issues around retirement savings, and I think we've done a very good job of trying to simplify those issues and help educate both people in Congress and also people in regulatory agencies. A lot of times rules are being made, but they don't always think about some of the second and third order consequences of these changes. Oftentimes regulation can be reacting to the last war and maybe overdoing it, trying to remedy some past problem rather than thinking about what might lie ahead. So we try to help provide a balanced view that helps them get it right in terms of how heavy or light it might be on the topic they're trying to address.
You've touched on this, but say a little more about what makes lobbying effective.
I think it's effective when we're seen as credible and advocating for policies that are durable and not particularly dependent on which administration or party is in power. Again, we're trying to think about the needs of investors who are going to be saving for many decades for retirement, for example. And so we're trying to help enact policies that will encourage saving over many, many years and allow investors a range of choices, not force them into only passive investments, let's say, but allow them a range of active options as well, provide low-cost choices to them, and just give both investors and advisors more choices and more ways to solve their particular needs.
I mean, I've heard you talk also about the importance of quote unquote smart regulation. Can you share a little more about what you mean by that?
Well, sometimes, as I mentioned, sometimes regulation tends to overreact to the past, and it can be very heavy-handed. So, one example was the SEC a couple of years ago enacted the names rule. So names of mutual funds had to correspond to exactly what was in the portfolio. It's a very well-intentioned rule. Of course, the name should, reflect what's in the portfolio.
Right.
The implementation of it was a bit more complex. And it struck me as a fairly heavy-handed, costly, complex rule to comply with for a fairly small problem, right? So it's the proportionality. Does regulation solve a problem with a reasonable amount of cost and complexity, or does it sort of over-egg that problem?
It's funny because at Capital Group, our names are often decades and decades old. Were we caught up in anything? I mean,
well, happily, very few of our funds had to change names because of it, in part because we try to pick names that are fairly timeless and can kind of go with any environment. But there were a few changes that needed to be made, or percentages that we could invest outside of something that pertained to that name.
Getting back to the public market question in general, what does concern you about public markets these days?
Well, I think as more and more of the public markets are taken up by passive ownership, you have less price discovery. Passive doesn't care about price or about value. In fact, passive will own more of a stock the more expensive it becomes, the more its value goes up and up and up, if that's not proportionate to the value it's creating through earnings and cash flow.
It's worth saying that again, because I think a lot of average people don't understand that kind of autopilot aspect to passive. So say it again. Passive, you own more of it, the more...
So as a stock rises as a percentage of the index, let's say, it could be going up for two reasons. One, its earnings are growing and the stock price is growing with the earnings, or it could be that the stock price is going up much faster than the earnings because it's getting more and more expensive on a PE basis. So the passive investor doesn't really have an opportunity to make a judgment about whether that's a fair valuation. They're just going to own more and more and more of that stock as it goes up in the indices. Active investors can make a judgment about whether that valuation is reasonable for the earnings and cash flow that we expect from that company. And that's where I'm concerned that if there's too much passive ownership of markets, there is no price discovery. There's no valuation judgment being made. And that's where active management has such an important role to play in the capital markets. Someone has to be there saying, this is too expensive or this is too cheap, and help stocks to find their natural level. Another thing that concerns me is I think a lot of companies have concluded that the burdens, going back to regulation and smart regulation, the burdens of being a public company are too high. It's costly, it's complicated, the number of disclosures, the amount of regulation that applies, the personal liability to executives about the accuracy of their financial statements. A lot of managements have just said, we'd rather stay private. And that's where I think reasonable regulation, and I know the current SEC is working on this, kind of simplifying some of the requirements of being a public company in terms of how frequently they would disclose or the amount that they have to disclose. I think that would be helpful for companies that are thinking about coming public to be more inclined to do it if they view those burdens as not quite so high.
And one downside, if I'm hearing you right, if these burdens are perceived as too high by outstanding companies that are poised to grow, it would mean that the millions of investors who we represent or whose assets we steward won't be able to participate in that growth for their own savings goals if at the margin people are choosing to stay private.
Exactly. So you can think of some very well-known technology companies today that have grown very, very large, that are still private. And the benefits of that growth are accruing to a fairly narrow group of investors, individuals, venture capitalists. Whereas if those companies had come public sooner, maybe the benefits would be shared more widely with millions of investors, potentially. So the public is missing out on some of the benefits of the growth of those companies. So again, I hope that some favorable regulation might mean that those companies could come public sooner.
Well, so how do you think about the role of private assets in a retail investor's portfolio?
Well, we believe there's a place for them, but it should be small, and it should be thought of in a very different way than their publicly listed assets. Private assets should be thought of as something you're going to hold for a very, very long time, because typically they have less liquidity, they have less transparency, and often they have higher minimums, or there may be fees involved, where you just want to put this investment away and really not think of it as something you're going to access frequently, if at all. And so it's important that the vehicle that it comes in matches the underlying assets. Capital Group has worked together with KKR to design an interval fund that is a combination hybrid public-private investment. And we've done that in part so that the nature of that vehicle will match the nature of the underlying assets. It has periodic liquidity, but it's not daily liquidity. It has more reasonable fees and minimums that are typical of most private market products on the market, but it's not for everyone, and it should be a small part of a person's portfolio. Mostly what we're focused on at this point with it is education. Education for investors and education for advisors who would sell it in terms of who it's appropriate for and how it works relative to other private asset offerings.
And so the goal of this partnership is to almost democratize access to some of these opportunities, but without it becoming an undue portion of any retail investors.
Exactly. We think there's a lot of demand for this, in part because a lot of these assets have moved away from traditional markets, from public markets, or from the banking system, for example, for private credit. A lot of those assets used to be in the banking system, and because of banking regulation, a lot of that's moved out of the banking system into the private credit markets. So there are large markets that can be accessed here, and there is a place for that in an investor's portfolio, but it should be small and it should be appropriate relative to that investor's risk tolerance.
And somehow the hybrid structure that includes the Capital Group's public securities provides some measure of liquidity for the retail investor when they need it.
Exactly.
Now, recently, the concentration in public benchmarks has increased dramatically. If you're a passive investor focused on the U.S., then your performance is now more sensitive to the performance of the largest firms. So in some sense, the passive investor is less diversified than ever. Is there a role for passive?
Yes, there is. Passive is a good way to get started as an investor. It's better to have money in the market than not. It's not timing the market, it's time in the market. And just being in the market in a low-cost way is great for building long-term wealth. Passive plus active is even better. Passive is very low cost, gives you market exposure. Active can give you that objective, that outcome that you're looking for that might be different than just matching an index. It could be better than an index, or it could be something different like income, like downside protection, some other combination of objectives that's beyond just what an index can provide. But there's certainly a role for passive in an investor's portfolio.
Let's talk market efficiency. Do you believe that markets have become less efficient, as some have argued, with prices deviating from fundamentals for longer? I mean, some observers blame passive investing. They say that mispricing creates opportunities for active investors then. But if that lasts too long, does it make it harder to take advantage of these opportunities? And how do you think about it? Do you see more or fewer opportunities for active investors in public markets now than, say, 2 or 3 decades ago?
Well, I certainly don't think markets are purely efficient. I mean, we can see the way that stocks react to relatively short-term noise like quarterly earnings. They're reacting, 10, 20%. If they were efficient, they wouldn't react like that. We try to think about this as the difference between weather forecasting and climate change. In the short term, you're forecasting the weather. In the long term, it's climate change. We're trying to invest around long-term trends. And so short-term dislocations are actually helpful to us because they provide opportunity. If we think we have the long-term trend right, we might be able to lean against the short-term noise. If the market's upset about one quarter's earnings, we might think that the long-term thesis is still intact, and we might lean into that and use that as an opportunity. We do believe, in the end, that fundamentals win. Stock prices are ultimately determined by earnings and cash flows. And so the proof is in the pudding. When we look at our results over very long terms, 90+% of our strategies are beating their benchmarks over their lifetimes. Net of fees, that's about 82%. And 78% of our strategies are in the top 2 quartiles versus our Morningstar peers. So relative to our active competitors, our approach seems to be working, focusing on the long term and taking advantage of dislocations to do, again, the fundamental research and fundamental evaluation of companies.
Does it get harder to beat your benchmarks as your assets under management grows? How have you in the investment group handled that?
So the way that we've managed to scale our funds is essentially by being modular. We continue to add managers because in equities, at least, adding more managers doesn't mean that we're canceling each other out. We can add managers who have different styles, different areas of the market that they focus on or specialize in, and we can continue to essentially add modules as we add managers to a strategy. And that's done very well for us over time so that it never becomes too much for one person, doesn't become dependent on a single person. It's the team and the complementarity of all the different managers that make us successful.
And that's a difference from other active managers, as I understand it. That's sort of the secret sauce of the capital system, as we call it.
Many other managers have a star system where it might be one principal manager per fund, maybe with some folks assisting him or her. But
no matter how big the fund gets.
It's often one person's judgment. We think it's very hard for one person to be knowledgeable on everything. So if we can put a team of managers together who have different strengths and who do well in different market environments, they're not all going to be up or down at the same time. That complementarity, if everyone's doing their best, that complementarity gives us an above average result with below average volatility.
And is it right, because I've heard colleagues talk about this, that tremendous thought goes into assembling the right team of portfolio managers to manage our larger funds? Talk a little bit about that.
Yes, it's both art and science. We use a lot of data to look at how managers do in different types of market environments, up markets, down markets, growth markets, value-oriented markets. What characterizes a person's style? What are their strengths and weaknesses? Many of our managers have been analysts for a long time before they become PMs, so we have a good idea of what their strengths and weaknesses are as investors there during their analyst career. And so we use all that data, but we also just know the people and we know how they get along with each other and who works well with whom. And so there's both the quantitative aspects of it, and then there's the personality aspects of what makes up a high-functioning team. And so we look at both in thinking about how we assemble those teams.
So many people around Capital Group talk about the capital system as the kind of essence of what we do. What is the capital system?
Everyone you talk to about the capital system will give you a different answer, but it really boils down to three things: collaborative research, diverse perspectives, and a long-term view. Collaboration is key to our approach. Analysts, portfolio managers all over the world, roughly a third of our investors are outside the US. We make 22,000 company visits a year. We're all providing different inputs and putting it together and thinking about things together to come up with investment approaches and ideas. Second, the diverse perspectives. It's really important to have a lot of different points of view, to be able to challenge each other, to see things from different parts of the world, from different industry sectors we're covering. Everyone brings something a little bit different to the conversation, and we get a much more well-rounded picture. And then thirdly, having a long-term view allows us to invest across cycles, not around the quarterly noise, but to really try to identify long-term trends and invest in the companies that will be the winners based on those trends over many, many years. And if you compound those winners over 5, 10, 20 years, that's where you really have an investment edge.
How do you think about the capital system?
The closest analogy I can come up with is that of a symphony orchestra. We don't expect every member of the orchestra to play every instrument. We expect them to be great at the instrument they play. And if you think about our investors as if they're members of a symphony, each one is playing their instrument to the best of their ability. It's when you put the combination together that you get beautiful music. And the principal investment officer of the fund is sort of like the conductor, trying to keep not too loud on the horns and a little bit more on the violins and managing it all as a beautiful ensemble. And that's really the way I think about our investors. Each of them is great at different things. They're not all great at everything, but if we put the right combination together, we get beautiful music.
Jody Jonsson, thanks so much for being with us today.
Thank you, Matt. It's been my pleasure.